guests at the table here. Congressman John Campbell, Republican of California's 46th District. I have to put my glasses on when I do that. 48th District. See, I'm always missing numbers without these glasses. Pardon me, Congressman.
I have my own right here.
Okay. We're squared away now. And importantly, a member of the Financial Services Committee. And on my right is Christian Weller, who is senior economist at the Center for American Progress. We brought them in today as the Congress prepares to hear testimony from Fed Chairman Ben Bernanke and from Treasury Secretary Paulson on a proposed series of financial market regulations. Before we get into the pros and cons of the proposals, I'd like to ask both of you to give our audience your assessment of how serious the issues are with U.S. financial markets right now, beginning with you, Congressman.
I think they're serious, Susan. This particular malaise, which began with the housing crunch and the mortgage crunch that started back in the middle of last year. Most predictions, as Christian and I were discussing before we came on, were that, well, we'd have a tough first quarter this year and a tough second quarter this year, and then things would start to recover in the third quarter. Well, we are in the third quarter, and things are not recovering, and now you see most people talking about this economic malaise, which is not yet an official recession, but continuing well into next year, if not beyond. And part of that, I believe, is that in addition to the mortgage problems that began last year, you now have the energy prices, and the energy prices which are causing moving us towards stagflation, where prices are going up, everything being driven by energy costs, but at the same time the economy is going down or going flat. So you add that on top of the mortgage situation, and you now have failures in mortgages that are not just related to bad lending practices of the last few years, but now you have some traditional recessionary type failures going on where people just have lost their job, whatever, are not able to make mortgage payments. So I think this is a difficult situation. The Bear Stearns near failure, which was stopped because it was believed it could have set in motion a kind of domino effect through these counterparty transactions, which could have been cataclysmic to the markets. There's nothing that says there isn't another institution out there that could be in a similar type situation. So I think we are a long ways from being out of the woods, and that the situation is still very serious and needs to be taken seriously.
Dr. Weller.
Well, thank you very much. I agree with the Congressman on the assessment of the situation. I want to add to this, though, that because this crisis is a mortgage crisis, it is the first time where people really, the point is driven home that Wall Street is not isolated from Main Street, that the two are linked together, the fortunes of the two are together. And I think we've had a series of bubbles. We had the internet bubble, we had emerging market bubbles, we have had now the mortgage bubble, and now we're at the commodities bubble. But the mortgage bubble, more than any of the other ones, really drives home the point that what happens on Wall Street does affect Main Street, and then that we have to get it right, that we got to make sure that we reduce the the volatility on Wall Street to some degree, because it is detrimental to families, to businesses. We know at this point it's not just homeowners, prospective homeowners who don't get mortgages, but it's also small businesses. You got to remember 55% of all loans to non-incorporated businesses are mortgages. So as the mortgage market contracts, we are pulling the rug out for not only for families but also for businesses. And so I think that needs to be kept in mind as we talk about how we go forward, how do you avoid this from happening again.
Okay, let's move into the plan put forward by the administration. First of all, we have on graphics an explanation of the overall objectives of this. Let's show it to you. Maintain market stability by creating a resolution process that ensures that the market can withstand the failure of large, complex financial firms. And some more details. Secretary Paulson's plan, the Federal Reserve should have the authority to limit undue market disruptions. Use of that authority should have a high trigger, such as a bankruptcy filing. Use should be focused on areas with greatest risk of market instability, and the use of that authority should involve the engagement of the executive branch. Okay, so let's help people understand what exactly the Secretary is proposing that the Fed should have.
It's a little unclear. When Paulson first came out with a proposal a few months ago, it was a little short on detail. The general idea, though, is to give the Federal Reserve the ability to collect more information from entities that are currently not regulated, such as hedge funds. It is unclear, for instance, though, whether the Fed would collect this information by itself or whether it would actually make it public so that market participants would know what's going on, which was a big issue, especially in the subprime market. Then the other part is also at what point would the Fed step in? What kind of triggers do we really talk about? I mean, the discussion here is that the Fed would then intervene, and presumably the way it has done with special lending authorities to stabilize the market, such as it did with Bear Stearns. Those are new tools, and presumably that's the road they're thinking. But again, it's not clear what these triggers would look like, and I think that's something we need to know from the administration. What are they exactly thinking in terms of when would the Fed actually step in?
One clarified question before we go to the congressman. When they step in, such as they did with Bear Stearns, where does that capital come from?
The Fed has a number of resources in terms of fundraising. It can issue bonds. It has a number of just simply money-making abilities, and that's what it uses for this. It's not taxpayer money.
The Washington Post yesterday had this headline, Congressman Bernanke endorses expanded authority. Do you?
Well, first of all, I'm not sure that I completely agree with that headline. Again, Chris and I were discussing before we came in here that a lot of the press reports have indicated that Bernanke is wanting to sort of greatly expand the Fed. If you actually read carefully what he says, and what he says is worded very carefully because everyone knows that markets around the world hang on every word. What he's saying is that perhaps the Federal Reserve, in addition to the responsibility for controlling inflation and growing the economy, could add stability of markets. And that if you add stability of markets, there might be some additional authority they may need or may want to have. I guess I can see that, but my concern about all of this, and when you put up what Secretary Paulson said, I think, frankly, it's hard to disagree with that. I think most people would say, well, no, we don't want to allow a failure that would cause the economy to collapse. But the more difficult question is, well, how do you do that? And how do you step in on that and not disrupt markets and not give financial institutions the idea that, oh, we don't have to worry because if we get in trouble, we'll get bailed out, because that will have investors making a lot of bad decisions if they believe there's no risk of loss or the risk of loss is limited. So the question is more how you implement this. And my concern about expanding the Fed too much is, I mean, do we want the chairman of the Federal Reserve, do we want the president to sort of be in a subsidiary role to the chairman of the Federal Reserve? If you give the Federal Reserve too much clout, too much power, then you essentially have an economic czar in the United States. And I'm not sure that we want to put that much authority or responsibility on one individual person. That being said, there's room somewhere in the middle, I think.
Let me give the phone numbers and then we'll come back to you. We'd like very much to involve you in this discussion, so here's how you do it. Republicans can dial us at 202-737-0001. Our line for Democrats is 202-737-0002. And our line for independent callers, 202-628-0205. And if you're a regular caller, reminder that we have a once every 30 days policy here. Your response?
Well, I think the important thing is to look at the Paulson and the Bernanke statement in combination. I mean, Paulson is saying we want to give more authority to the Fed, and the Fed says, like, we don't want it. I mean, you read the Bernanke statement, he's like, well, if the Congress wants us to take it, then we reluctantly we would do it, but then we have to do it very carefully and all of that. And I think that's an important thing to consider, that this is a Federal Reserve Bank, both under Greenspan and under Bernanke, that really was, for a long time, very reluctant to consider asset bubbles and stability as part of their mandate. And Bernanke is in that tradition. And so I think you're not only talking more authorities, you're ultimately talking a completely different Fed and a different interaction between the federal government and the Fed if you want the Fed to play that role. It would require much stricter oversight, for instance, from the Congress to hold them accountable to that, because they're already saying we don't want to do this.
Let me share with you, before we go to calls, the Washington Post editorial page view on this. Their lead editorial today, Bailout Ben. It's up to Congress, not the Fed boss, to regulate financial markets. Here's what they write. Mr. Bernanke clearly feels he has to improvise as long as the financial system is still shaky and Congress does not fill the legal vacuum. Indeed, he pressed ahead even after Senate Banking Committee Chairman Chris Dodd and the committee's ranking Republicans Shelby asked him not to. Perhaps Mr. Bernanke, like many other people, doubts Congress's ability to write new rules in what's left of this election year. Yet Congress, they say, must act, and sooner rather than later. And they say, here's why. The Fed is supposed to be the independent guardian of the dollar's value, not a fourth branch of government for financial policy. Direct support for and supervision of Wall Street, absent clearer statutory authority, risks politicizing the Fed. Here's how they close. Ultimately, how much to regulate the financial markets and how much taxpayer money to risk on bailing out them are political questions, not technical or economic ones. Mr. Bernanke has done a good job at crisis management so far, but he is neither uniquely qualified nor constitutionally authorized to build the permanent new regulatory structure that the financial markets need. I'd like both of you to react to that.
I guess I'd say I somewhat agree. Certainly, as I kind of alluded to, as we were talking about before, I don't think we can make the Fed into a giant autonomous arbiter of all things economic. I don't think that's a good idea. Some of those things need to be retained within Congress or the executive branch. However, that being said, they needed to react fast. If you look at the Bear Stearns situation, that was handled by the Fed and the Treasury Department and the SEC over a weekend. I mean, between a Friday and a Sunday is when they put all that together. You know, we're not here all the time. In 3 weeks, we'll be on recess for 5 weeks. And so if something were to occur in that time, you would need to have the Fed able to respond without having to wait for us to give them the authority to respond. So I agree that ultimately the authority should rest with Congress, but we need to give them the tools so that they can react quickly, because things are happening very, very quickly, and unanticipated things have been and will probably continue to happen in these markets.
Dr. Weller.
Well, I think I agree. The important first step has to be for Congress to set a framework for the Fed to act in, or whatever super regulator we imagine, stability regulator, whether it's the Fed or somebody else. And I think the ball is to some degree in the Congress's court to say, okay, well, these are the rules, this is what the framework we're envisioning, and then we give the regulator the tools to intervene, whether it be that the Fed or somebody else. The Fed has proven it can be very agile. The Bear Stearns example is a good one. We have a number of those in the past. So the Fed has some track record in terms of intervening in the markets and maintaining the stability of the dollar, of the currency, and of prices, and in this case, asset prices. So I think the Fed could play that role, but again, I think it requires a different framework. It requires a clear guidance from the Congress what they're actually expecting the Federal Reserve Bank to do.
All right, let's get our viewers involved in the conversation, beginning with a call from Laurel, Maryland on the Democrats line. Go ahead, please.
When I look at the credit crunch, I see the basic problems as being very similar to those of 1929, which is to say excessive speculation relative to investment and excessive leverage. And I think that part of the problem is that many of these toxic financial structures we looked at have been called admirable financial innovations by people in regulatory positions. I'm thinking particularly of Alan Greenspan. And I was wondering what you folks would think of, Dean Baker's proposal, which actually is in effect on the London Stock Exchange, but he has a proposal for a relatively small transaction fee or tax on financial transactions, which for an investor would be minor because it would be on the order of less than 1/4 of 1%. For someone who's aggressively speculating, hence in and out repeatedly, would make that a far less attractive proposition for them.
Thanks very much. Congressman, are you familiar with that?
I'm not.
What do you think of the idea?
I'm not. It's the first I've heard of that particular proposal. I'm not quite sure I understand how, if it's a small tax that shouldn't bother the investor, and if you're looking at someone who is a frequent trader or speculator, they're usually doing that kind of things for very large percentage gains in a very short period of time. So I don't know how this would retard them at all, and I'm not sure that taxing something like, if you don't like a particular transaction, regulate it, but don't tax it. That would seem to be my response. So I'm not wild about it.
Before Dr. Weller responds, what do you think of the caller's first analysis that the fundamentals of our market are very similar to 1929?
Well, people like to say all that sort of thing in order to speculate that we're heading towards some other kind of a crash. I think we do, as we just saw with Bear Stearns and so forth. I do think we have an awful lot of mechanisms in place to keep that kind of thing from happening. I almost think it's maybe a little more similar to the late 1970s, 78, 79, 80, when you include the energy factor in there, and you have a little bit, and you have stagflation developing and that sort of thing. So I think it may be a little more akin to that. But each one of these, I think, is different. I think it's dangerous to go back and say, oh, this is just like 79, or this is just like 29, or this is just like whatever. It is unique. The time is unique. The situation is unique. And I think we have to develop solutions and responses today, not looking back necessarily at those.
Well, I think the first question on the speculation issue, I think it's important. I agree with the Congressman. This is a unique situation, and let me explain this. I think we focus too much on the subprime crisis, but I think the subprime crisis ultimately was just one symptom of a longer-standing crisis. Because it wasn't just 2005, 2006 where we flipped a switch and said, okay, well, now we create a crisis. You got to remember the housing bubble started in the mid-1990s, and definitely by 2000 we knew we had an overvalued housing market in most regions. So in part and parcel of this was also people borrowing more. It wasn't just a housing bubble, but also a mortgage bubble, because people's incomes hadn't risen. We had a weak labor market, weak wage growth that ultimately forced people more into debt. That ultimately translated to the subprime crisis, but that was just the icing on the cake. The longer-standing mortgage problem, the debt burden that we've built up, that was ultimately something that was more long-standing. So the question then is, how could we have prevented that? And that's Dr. Baker's proposal. Dr. Baker is a friend of mine. It's initially a proposal by Professor Jim Tobin, a Nobel Prize winner in economics. The idea is a transactions tax to retard speculative transactions. I don't think Dean would necessarily argue that his proposal, a small tax, would retard financial transactions. The idea is saying, okay, well, speculators are making a lot of money with this. Let's siphon off a little bit on that and use that, for instance, into stability pools so that we can then finance a Bear Stearns bailout or something like that out of that, or that we actually have the resources to help homeowners who are struggling as a result of the bubble.
So it has a different purpose than the caller interpreted.
It is a different purpose, yes.
Next call's from Blairsville, Georgia, Republican line. Good morning. You're on the air.
Yes, good morning, Susan. I think one of the problems we have with the Federal Reserve is the average citizen does not understand this dark entity called the Federal Reserve. The chairman we know, either Greenspan or Bernanke. However, from what I know about the Federal Reserve, it was created in 1913 along with the income tax. It was basically supposed to regulate our economy, not control and manipulate it like they do. Now, we know they have governors, like 7 governors or 14 major banks, and they all have branches, but we don't really know, I'm talking about the citizens, the average taxpayer, the worker in this country, actually who controls the money that goes in. Now, we know Congress was supposed to print money. They gave that and regulate our economy, and however, they gave that authority just about basically to the Federal Reserve, and who was supposed to balance unemployment and inflation. And how they do that, we don't even know if these people who control the Federal Reserve are actually U.S. citizens or have the best or the economy of the U.S. in interest. Most people think it's a central bank that is turning to a global bank. Could you please comment on this, please?
Congressman.
Well, first of all, I think I'd tell the caller I'm not sure the average congressman understands quite what the Federal Reserve does, not to mention the average citizen. But I don't think it's quite as dark and scary a box as the caller suggests. It is a very complicated, these are really complicated issues. And what they're dealing with in financial markets, particularly today, given all the different instruments that are out there, and after the Gramm-Leach-Bliley reforms and so forth, this is a very complicated financial world, and it is a financial world. I mean, whenever we talk about things we're doing in the United States, we are no longer an island in that respect. Everything we do has international investors here and our investors investing internationally. So I think it's not quite as deep and murky and suspicious as the caller suggests, but it is very complicated. And that's why the solutions to this are not so simple.
Well, I agree. I don't think the Fed is all of that much of a black box. The Fed has become much more open over the years. We know what its goals are. It has to strive for full employment, maximum full employment, and price stability. And the Fed has made its decisions, especially on a Bernanke, much clearer. The statements have gotten clearer. The minutes are released earlier, so we know the deliberations. The Fed has released a number of documents that basically let us look into its decision-making process. It releases, for instance, more of its long-term models in terms of its economic forecast. And so we know what the Fed is, how the Fed is assessing the economy and how it makes its decision. We also know that the Fed has limited tools. The Fed is using largely only interest rates. And that is, I think, a tall order to use one tool, just a hammer, to solve all the problems that you may have in your house. And I think that's ultimately where we're struggling with, that the Fed can really only use largely interest rate movements in trying to affect inflation, unemployment, now financial market stability. And I think that's ultimately a challenge that has been proven tougher to solve than most people thought.
Christian Weller has his PhD in economics from the University of Massachusetts at Amherst and has spent his career so far in the intersection of economics and public policy. Congressman John Campbell of California has his bachelor's degree in economics and master's in business taxation from the University of Southern California. He is a certified public accountant and tax accountant with the company that is now Ernst & Young in Los Angeles, and 25 years in the automotive industry before coming to the U.S. Congress. For our two guests, we're talking about the financial markets and proposed regulations that would give the Fed more authority to stabilize the financial markets. There's a hearing today on Capitol Hill. Will be live coverage of it on C-SPAN 3 beginning at 10 a.m. Eastern Time today. Next telephone call on this issue is from Chicago. You are on the air, Chicago. Go ahead.
Hi, good morning.
Good morning.
We hear about the financial markets causing the housing crisis, but yet nobody that I've listened to has spoken of the health care system in our country that's been affected by financial institutes and the instruments that are used. There is a trial, it's an ongoing trial, in Columbus, Ohio. It's National Century Financial Enterprises Incorporated, which federal prosecutors have claimed to be the largest privately funded financial fraud case, even bigger than Enron, that has occurred that nobody is paying attention to. Now, there is the big guy, Lance Polson, is scheduled for trial in August. I really wish that somebody will pay attention to this, because this is a result of healthcare companies that are on the brink of bankruptcy, and they went to this NCFE for financial support, which they were paid, multiple, depending on the ratio for their medical billing, their billing procedures. But yet the fraud, this is like over a $2.9 billion, with the B, dollars worth of fraud. And there's many people, many companies that are involved in this. Please address this.
Thanks very much. Dr. Weller?
Well, I don't know the specific case, but it sounds like one of those cases where what we sometimes called raiders, the Wall Street raiders coming in, hauling out a company and selling off different assets. And to some degree, we've seen a number of those cases. The problem is that often we don't exactly know who the financial investors are. And I don't want to comment on a particular fraud case. It may be fraudulent or not. But this is something we've seen in manufacturing and other industries, where what is perceived as a savior in a troubled situation, like a private equity fund or a hedge fund, ultimately turns out to be less of a blessing and more of a curse. And the problems ultimately there are somewhat a lack of transparency, and then the other part is that these firms often borrow heavily in other markets to then make these investments, and that can, so that even if this investment goes belly up, there is a lot of spillover into other markets. And I think there is the need for more transparency, to know what's going on in these transactions and some of these private equity transactions, to ultimately stabilize and keep things from spiraling beyond just the initial case.
Wall Street Journal has almost a full-page editorial today on Fannie Mae, and I'd like to bring Fannie Mae into the discussion here. Now, what they point out in this, if you've both been referencing Bear Stearns, that by comparison, they remind us that Bear Stearns was a guarantee of $29 billion. Fannie Mae and Freddie Mac, by comparison, add up to some $5 trillion in liabilities. And it says here that the liabilities of Fann and Fred are currently not on the U.S. balance sheet, but one danger is a run on the debt of either company, putting pressure on the Treasury and Federal Reserve to publicly guarantee that debt to prevent a systemic financial collapse. How concerned are you about this possibility?
This will be one of the great debates and discussions in Congress, I think, for the remainder of this Congress. Fannie Mae and Freddie Mac have had and continue to have what has been called an implicit guarantee of their debt by the federal government. But by virtue of it being implicit, that means, by definition, it is not explicit, and so therefore it is not specific. And you have seen the stocks of Fannie Mae and Freddie Mac go up. Yesterday, one of them fell 24%. The day before that, that same one was up 15%. So there's a lot of nervousness in the market about these things. That implicit guarantee that is there, frankly, whether it is implicit or explicit, 50% of the mortgages in the country are guaranteed or held by Fannie Mae and Freddie Mac. You cannot allow that to fail. Now, this gets back to what Secretary Paulson has been talking about recently, something that's too big to fail. That doesn't mean it's too big to let investors lose money. So that's where part of the rub is. You clearly can't let Fannie Mae or Freddie Mac have some failure or something that leads down. That would be catastrophic for the economy, and it cannot be allowed to happen. But that doesn't mean that people who made investments perhaps that didn't turn out so well, they shouldn't have made, aren't going to lose money because they have to, or else markets won't work appropriately. So I think there'll be a lot of attention. I think we have to be very focused on it, and it is a concern.
Christian Weller.
Well, I want to tell the Wall Street Journal to take a deep breath here. We were enthusiastic, and the markets were enthusiastic, overly euphoric through 2005, 2006, and now we seem to be in panic mode every day, and as if this thing will never turn around. And I think when you look at Fannie Mae and Freddie Mac, their portfolios are generally stable. Yes, they had very little on the subprime side, but as the problem has moved up the ladder in terms from the subprime to the prime market, the problems have spread. But nobody's imagining that $5 trillion of mortgages will be lost. A small percentage may be lost. That hurts the capital of Fannie Mae and Freddie Mac. It's larger than people had expected. You can solve that with a capital infusion. You've got to remember, even with Bear Stearns, we're ultimately talking close to $300 billion in assets. The Fed had a backstop guarantee of $30 billion, and nobody expects that these $30 billion will be lost. Possibly a little bit more than $1 billion may be lost. But so I think the problem is much smaller. I mean, it makes for a nice editorial to say this is a $5 trillion problem. But I think the role here for Congress and for regulators is to kind of tell the world, don't panic, things will get better, and take a more long-term view. Don't look just to the weekend, but look to next year or next few years.
Do our two conversations intersect here, though? Are the proposed regulations from the Treasury Secretary, would it give the Fed different kind of authority if there were a problem in Fannie Mae or Freddie Mac?
And not really, as far as I understand it, because it is already a financial institution that would be regulated.
Right.
The regulator is OFEO, and I don't think the
there have been specific proposals out there to Fannie Mae and Freddie Mac don't have a single strong regulator under today's rules. And so one of the discussions is if we're ever going to make this implicit guarantee more explicit or imply it even further, that the government should have one single strong regulator that is over Fannie Mae and Freddie Mac. A bill to do that actually passed the House. It just hasn't passed the Senate yet, and there's bipartisan agreement on that. So I think that one way or another, the question is what else comes along with that, and that's why it hasn't passed. So I think eventually you'll see that, and I think it's necessary.
Sherman Oaks, California. Good morning. Republican line.
Yes, hi. I want to speak to Representative Campbell from my state, and I have a suggestion, and that is if indeed we're going to engage in these financial bailouts, and I believe that's what they are, that whatever agency, whether it's the Federal Reserve or or the SEC or whatever, that they have the right, that the minute that they say that they're going to engage in the bailout, to freeze compensation for all members of the corporate board and senior management for a minimum of 1 year pending investigation to see if there's been any malfeasance or wrongdoing. And I know there are shareholder suits, and I know we have regulators, but we all know, I'm an attorney, it takes forever. And the bigger the institution, the more complicated it is. And while I support bailing institutions out to preserve our economy, I don't support compensation for people like Citibank's Robert Rubin, who made $100 million and ran the bank into the ground. And Citibank may be on the list of institutions that's coming up. Certainly Countrywide has managed to make that cut. And I don't believe that when you talk about not preserving the rights of investors, that's fine. It's a speculative investment. However, you shouldn't preserve the rights of those who may have done something wrong and are going to be compensated $20 million, $30 million, God knows what, stock options. Well, they won't be worth much, but whatever. I'm sure you got the idea. And the reason I suggest this is a tremendous step by the government to do this. And you want to have the support of the people, that we're not bailing out people like Enron and the other horrid people that have caused all kinds of financial catastrophe in this country. We don't want those people to walk away with $100 million and say, oh, well, it was just some bad business decisions.
Thank you, sir.
Okay.
We got it. Thank you.
Okay, I'll say to my fellow Californian there, who's up very early, congratulations to you. I agree with what you're saying. The question is a little more, again, it's very easy in this complex environment to agree on what the outcome should be. It's very difficult often to agree on how you get there. Let's take Bear Stearns as an example. I mean, that's the only bailout, if you will, that we have seen so far. We really didn't bail out Bear Stearns. That isn't what the shareholders of Bear Stearns had, and these numbers are close, but they're not exact. I think a year prior to the bailout, the stock was at $160, and they ended up getting $10 a share. Well, they lost a lot of money. The employees pretty much all lost their jobs. The managers all lost their jobs. Everybody lost a lot of money in Bear Stearns. Who really got bailed out are the counterparties, all these other institutions that had these counterparty loans and various guarantees and so forth of some of the Bear Stearns debt. Now that's spread throughout the entire financial world. So I don't know how you then go in and say, all right, to all these dozens or hundreds, I don't know, of other financial institutions that had this counterparty debt, that we're going to control your management fees. So I think I understand what the caller is saying, and I agree with the spirit and intent, and certainly we'll try and do that. If we're doing this, we're doing these things not to save the companies, not to save the executives. We're doing this to save the economy.
Well, it's an interesting proposal, and it speaks to fundamental fairness. If some people who basically created the subprime problem shouldn't be rewarded for it. We had this discussion around Countrywide. The problem is, what is a bailout? What's government support? And I agree with the congressman. I don't really think that Bear Stearns was necessarily what we consider a bailout. It's not like a blank check. I mean, the first $1 billion of losses is with J.P. Morgan. So I think and with other things, like, it's hard to identify what a bailout is. Just everybody who borrows from the Fed, which regularly happens, would consider it be a bailout in a situation. And so I think the discussion, the shift here has to shift back to a different realm, and that would be the executive compensation realm. I think in the Citibank case and others, if people make a lot of money even though the company is going under, and that happens in about 20% of the cases, then I think the shareholders have to take responsibility and write different compensation packages for the executives. And I think that's a different argument. I don't think necessarily there's a realistic way of tying the two together.
Leesburg, Virginia, good morning. You're on, and welcome to the discussion.
Yes, hi. As a layman, first off, I'd like to, echo the sentiments of, I believe, the congressman earlier about executive compensation. I think it's absolutely horrible that these guys get paid, $20 million for essentially failing their company and failing their shareholders, and the board is inept and the shareholders don't have enough say, I suppose, to vote these guys straight out of their, cushy offices. But I was wondering, I don't know exactly what happens during one of these bailouts, but I was wondering if, and I don't know if this would work or not, when we, bail out a financial institution, why can't we inspect their books and just as if, I were applying for a credit card as a consumer, they see that my, debt-to-income ratio is, sky high. I get a, 30% interest rate on my credit card. Why don't we require these banks, when they're bailed out, to pay some, large amount of interest to give them economic disinterest into, failing in the first place, I suppose. I'm just kind of wondering if there's some way of sliding scale of interest rate that they have to pay back the federal government at a large amount of interest rate in order to discourage them from doing shady practices in the first place. Thank you.
Thank you. For you.
I think, as Dr. Weller said, first of all, on executive compensation, that's really between the shareholders and the board of directors and the company. And I happen to support a proposal that would give shareholders greater rights to offer alternative members of the board of directors for election to the board of directors, because the proper way in a company for shareholders to express their displeasure with a company and with their executives is through the board. And so what they should be able to do is change the board, and that's something I think you'll see a lot of discussion on in Congress next year. But as far, again, as this bailout, I think what the caller suggested is what is, in fact, has happened, and what is the discussion that is happening is that, as Dr. Weller pointed out to the last caller, the shareholders at Bear Stearns lost a lot of money. Morgan Stanley, it was really facilitated for Morgan Stanley to take it over. Morgan Stanley has a great deal of risk to lose a lot of money. And so as this thing was put together, and if there are future ones that are being looked at, I think there is agreement with Congress, the Fed, the Treasury, everybody, is to make sure that people still have that risked money and lost it, lose it, and that people who step into those shoes still bear the risk of loss more so than the taxpayer, and that just what the federal government does, or the Federal Reserve, is facilitate some kind of transaction that keeps this domino effect from happening, which is these counterparty guarantees, which a lot of people, we talked earlier about people not understanding quite what the Fed does, and because what the financial markets do, that so many of these financial institutions have guarantees, second and third and fourth level guarantees with other financial institutions, and that's the problem out there that we have to stop from dominoing down.
Well, the caller mentioned two things. The first one is to have somebody inspect the books, and the second one is to share the losses. And you read the Bernanke speech, and both of them are in there. The Fed has actually now their specialists together with the SEC at the various dealers, broker-dealers, and is actually looking at the books and is actually trying to work with them. And so we have the agency already in place. And it's not just simply somebody picking up the phone call. They're actually physically there. The other part is also, you look at the Bernanke speech, he's actually proposing a step in that direction, saying, okay, well, if this happens, there should be a bridge bank that basically says, okay, well, this bank is failing, we're taking them over, and we're going to apportion losses to the shareholders and to others appropriately. And I think that's that's a new proposal, and I think that's something that I think we should look at. I think he's making a historical comparison. Unfortunately, I'm not familiar with that one.
Since we've been at this conversation for a while, at the beginning we showed you the objectives of the Paulson plan for additional oversight of the markets. Let's put that on the screen over our next call as we wrap up here, so you have a sense of the policy directives, or objectives rather, as the hearing gets underway today. Next telephone calls from Little Rock. Good morning.
Yes, I am a conservative, but I'm going to tell y'all something. This Bear Stearns, they bailed out, and these well, they're really not banks. They get in a speculative market, and they don't. They're not really banks, and we're bailing them out. In first place, they shouldn't be making these loans, and then bail them out, and we have to print money, and the people overseas, like China and Japan, buy these loans up. before long, these people overseas is going to own us if they don't already. We can't even press China and them to do anything about all this drugs and everything and food and everything else coming over here and toys or anything else because they own us. They near it.
Thank you very much. Dr. Weller.
Well, I think there is a number of issues here, but let me just speak because we haven't talked about it, the China situation. The problem is that we're not a saver nation anymore. We have deficits at the federal level. Households are basically not saving anything. The saving rate is zero. And so we need the money from somewhere. And right now it's China, it's the oil-rich nations who have the money and who are coming here. It does create some problems, and we saw this when Paulson met with the Chinese delegation in Annapolis a few weeks ago, when Mr. Paulson, the Treasury Secretary, said, well, we're going to talk to the Chinese about the currency and to help our manufacturing sector. And the Chinese said, like, well, but don't lean on us too hard because we're lending money to you and you got to get your house in order first. So I think it makes our situation difficult. I think the main thing as economists, what we know is like we can get the national saving rate back on track if we do something about the massive public deficits that we have at the federal level. That's probably a first step, and that will ultimately mean that we have to borrow less money overseas. So I don't think that's a separate issue, and I think the important thing is also that the Chinese and the British, the Swiss, everybody's coming in at the back end. They didn't create the problem in the first place.
Congressman, I'm going to take our last caucus. We're almost out of time, and then we'll come to you. Tampa, Florida. Go ahead, please.
Good morning. I hope this is a stupid question, but generally we have a formula or a philosophy when it comes to economics. And there was a movie, The Beautiful Mind, where this professor came up with an economic theory. But what are we going by? Wasn't it Keynesian economics at one time, trickle-down voodoo? What philosophy are we going now? Is it the one from that gentleman that I forget what college, Harvard, I think?
Thank you very much.
I would. Do you want to talk about Milton Keynes, or do you want to talk about the different?
Very quickly.
What kind of an economist you may be?
I don't think I'm an economist who believes in whatever works. And you look at Wall Street, and there's people who write about Keynesian economics and monetarist economics. I don't think the world fits neatly into one textbook version or another, and I think that's ultimately. And the congressman said it earlier, I think we're in a new world. We've never had this much debt, for instance, in private households. We've never had this much financial innovation. We had never had financial markets that were this complex and interlinked nationally and globally. So I think at this point we got to go with what works, and this will require, unfortunately, some trial and error.
Last question, which is a technical one. Does Congress need to authorize the Treasury Secretary to give these additional powers to the Fed?
Yes, I believe Congress does, and I think that's clearly what we'll be talking about today, or what a lot of the discussion will be in the Financial Services Committee today. And I don't know. These are big sweeping reforms that are being talked about. I'm not sure how much of that can be done in the short period left in this Congress, but we'll see. We probably need to do some things, at least move some things forward before we adjourn for the election.
Live coverage of the hearing today at 10 a.m. on C-SPAN 3 and on cspan.org on the internet. Gentlemen, thanks to both of you for setting the stage for that conversation today.
Thank you, Susan.
Thank you.
Our next guest will be the chairman of the Senate Judiciary Committee, Patrick Leahy. We're very pleased to have the senator from Vermont back at the table this morning.